Welcome back to BS Free, everybody. I am Dr. May Hindmarsh.
And I'm Dr. Tim Hindmarsh.
And the name of the show, of course, is The Promise, BS Free. And we spend most of our time cutting through the nonsense in medicine, the corporate spin, the bad incentives, and the stuff nobody wants to say out loud. Tim will do that for us, right?
Usually obnoxiously loud, and I don't apologize. There you go.
We get a lot of nonsense about physician finance. We get all kinds from real estate gurus, crypto bros, passive income guys. They're all spamming our DMs and our inbox on the daily. I'm deleting them. And so when a sponsor wanted to come on and talk to us about algorithmic trading, my answer was, sure, please educate me. And we would also like to test it on air in real time. So today's guinea pig, I say lovingly, is Jeff Sekinger, and he's the founder of NURP. That's NURP. He's built 3 companies. 0% in financial education is the name of it. Orca Capital, a digital asset hedge fund for the accredited crowd, and NURP, which licenses that strategy to regular individuals. And Jeff, this should be fun. When he gets on, he knows what he signed up for with us quizzing him.
Yeah, so look, our brand is BS free. So we really want to dig into what makes NURP different and ask some, potentially more difficult questions, because I like just thinking about the financial space and how unbelievably ignorant most physicians are, to be perfectly honest with you, myself at times and often included. We want to see, we want to test the waters here, because I've seen way too many people get ripped off by way too many scams.
Right. And I want to clarify that, full disclosure, this is a sponsored episode, and NURP is a partner of the show. This doesn't give them a free pass. It gives us a chance to answer the honest questions. And so NURP is a software and financial education company, not your financial advisor, and nothing in this conversation is financial advice. It's the start of your homework, not the end. Trading carries real risks, we know it, including the risk of loss. So are we ready to go?
Let's go.
All
Let's
right,
welcome
bring
Jeff.
Jeff onto the show.
Hey, Jeff. Welcome to BS Free MD.
Hello.
So
Thank
excited
you
to
for
have
having
you
me. I'm
here.
excited to be here.
Yeah.
bet.
Well, I guess I'll start. So you got 3 financial companies, 0%, right? Orca Capital and NURP. Congratulations, that's awesome. Most people can barely, get one going. So give us the real straight version, like how are they all connected, and what kind of problem solving do you guys do?
Yeah, so 0% was my first brand that I launched outside of college after I left JP Morgan in 2018. And that would actually spawn from my own financial journey, where I struggled specifically with my finances early in my career. And I actually rose my credit score from a 524 to a 793 in about 9 months. And that had a huge impact on me being able to get a different car and move into an apartment and be able to get, credit cards. And I learned how to use those to travel for free and how to fund my first, real venture into, internet marketing. So I used a lot of the things that I discovered myself in my own financial journey and started 0%, which we've helped thousands of people, really early stage business owners, just get access to different types of financing to start their business. And then that, Simon, I would say probably 9 months after that company started, after I left JP Morgan, I started my first hedge fund, really just to build a track record to see if I could make it a successful venture. And I'd always been interested in alternatives my whole career, even though I was in, the largest bank inside the United States in asset management. I was really focused on just portfolio allocation with higher net worth clients. I was still just always drawn to everything alternatives. So that fund is actually an alternatives fund, which is primarily in the digital asset space, like you mentioned, like crypto, Bitcoin, and we do quite a few different strategies. So it's not just like, buy and hold. And we also have a market neutral quant fund as well that is under that same umbrella. But what I realized is there's a huge gap in the market. After I was like running both companies, I slowed down a little bit on 0%. A lot of the employees that were there came with me into the other venture, NERP. And on Orca's side, I realized that there was a lot of people that were worth, let's say, 150,000, 300,000, $1 million, maybe even a couple $1 million, and they don't have access to get into some of these vehicles because they don't meet certain standards that is set by the United States government, which is like the accreditation of being worth over $1 million, or like our quant fund, you have to be a QEP, which is a $5 million net worth or above. And there's all these different statuses. There's even one above that that's an ECP, where you have to be worth $10 million. So working in the financial industry, I realized that there is really this big gap where people that are worth 250 grand to maybe 5 million, they don't really have access to things that people that are worth 5 million, 10 million and above. Because once you get to that level, first of all, you can legally invest in different types of private placements, and oftentimes you're working with a bank that you get pretty unique deal flow and different financial assets that you can invest in that you otherwise could not have invested in. So NERP started kind of with that foundation of like, let's try to give institutional grade technology to the high net worth retail investor. So we started the company about 4.5 years ago. We've had over 3,500 clients, and we found that a lot of our clients were busy, professionals, whether they worked in a C-suite position for a larger company, or they were running their own companies. And we had a lot of medical professionals as well. And yeah, that company's just quickly grown. So I'm happy to go into any direction you want, but I'll leave it at that for your.
So how do you do that? Like, how do you allow what Orca, which was the high end accredited investment hedge fund, how do you allow that access in NERP? Like, how does that actually work?
Yeah, so they're completely distinct companies, just to be clear, like completely
Okay.
separate and completely different models. The fund is really like a vehicle. It's really a business where people invest into the business and you own a percentage of the business. And those funds are pooled together into one entity, and then you invest those on behalf of the investors. So that's what an actual fund is. Now, on the NERP retail model, what we do is we just license the technology to individuals. Those individuals open up brokerage accounts with different types of brokers. It doesn't really matter which broker, as long as it integrates with our technology. And then they can deposit and withdraw money from their own account at any given time. So they're not giving up custody to us. We're not managing their money. They're not sending their investment dollars to us. They're just paying a licensing fee to use the technology inside of their own brokerage account. And what is that technology? We build different types of trading strategies that just make getting exposure to trading as a piece of your portfolio a heck of a lot easier than trying to figure out how to be, one of the 4 to 1%, depending on which study you look at, that are actually profitable when they try to trade for multiple years. Like 94 to 99% of people lose money when they trade. They try to trade individually for multiple years. So we're doing our absolute best to make sure that those numbers are as high as possible, as far as people being able to make money from trading, because there is exceptional benefits from it. It just takes many years in this learning curve to get to the point where you can have success. So yeah, we expedite that success using technology, and each user has their own account, and they can adjust small settings on the software themselves.
So does that still allow access to these markets that wouldn't be available to somebody that isn't accredited?
Yeah, so like I said, there's a little bit, the only difference really, well, there are a few differences, but the main difference is that you are in control of your own account. So the software does like 99% of the work for you. Okay, so it's entering, it's exiting, and it's managing the trades. Now, in a fund model, you're pretty much 100%, because all you're doing is you're sending a wire to a fund, you're signing the
Right.
subscription documents, and then you're just getting a statement every month. Now, if you look at the most successful hedge fund of all time, most people think, okay, who's the top investment manager? Who would you say that is, if
Well,
you had to
Warren
guess?
Buffett.
Yeah, exactly. Almost everyone says Warren Buffett, because he did on average like 20 to 30% a year over his career, which is exceptional. But people don't really know because they haven't really looked into it. The top investment manager of all time was a guy named Jim Simons that ran the Medallion Fund, and they averaged 66% a year for 30 years. Now, what were they doing to average 66% a year? They were running quantitative trading algorithms in a fund that managed the capital without any emotions. It was highly efficient, and they hired a bunch of really smart quants and mathematicians and developers to build these strategies into software that automate the process of trading, and that it happens in a fraction of a second. So knowing that the top vehicle of all time, and there's other vehicle. If you go look at Jane Street right now, they're a proprietary trading firm making $5 billion a month in revenue, profiting about 3.4 billion in a month, and they're the most efficient company of all time when you look at companies over 1,000 employees. So there's no denying that there is some secret sauce and huge benefits when the most successful, or I should say the most efficient company of all time is using the technology, and the top hedge fund of all time was using the technology to manage capital. So yeah, it does give you that intro into institutional grade, but it's in your own account and you're managing, your own account, but you understand how the software functions and you can adjust some small settings on your own.
Oh,
Interesting.
okay.
No, well, how much of what Simons did was quant trading? Because that, from my perspective, quant trading is essentially just picking a money tree.
100% of that fund was the Medallion Fund was
Yes.
quant trading.
Okay. All right. Well, that makes sense. We should probably explain a little bit of what quant trading is, because my wife's looking at me kind of like when I'm
Yeah.
eating steak and the Labrador Retriever comes up. And it's like, you going to share that?
And I like to keep it from a lot of people that write in, and my
if you
brain as well, the 7th grade level of explaining.
If you don't mind giving us like the 25-second to 1 minute version of what quant trading is.
Yeah, it's just like the finding a statistical edge in the market. So you design a certain type of trading strategy that is profitable. You back test that strategy over many years, and you can use the software and buy data for whatever asset you would be trading. And ultimately, you build that trading strategy into an algorithm. So the computer software is executing that strategy for you instead of you staring at a chart and waiting to enter and exit the trades. A software is doing that, but it's all based on statistics and mathematics, which is what finance and investing and trading really should be based on.
Right.
But unfortunately, most retail people, they use their emotions, or they say, oh, SpaceX just IPO'd, let me go buy this. But they don't know that it's like a 200x valued at a 200x sales. And, the unlocks are going to just keep picking up over the next 3 months. So you could kind of model that out. Like a quant would model out the potential unlocks of the equity that the insiders are going to dump, most likely to kind of realize their gain that they've been with a company. And there's all different types of quant trading. But yeah, it's a statistical edge that you create into a software to execute for you.
Perfect.
Yes, perfect.
Yeah,
Love it.
that's super helpful. Where are we going next? What do you want to talk
let's
about
talk
next?
a little bit about why a lot of our audience is freedom-minded physicians and people, and why this. I mean, I'm already starting to sense why your product would be right for them, because they want to, like you said, they get control over your product. They can adjust it as needed, correct? But I know a lot of people will just have their money, just plug it into the 401k, and you don't really have a ton of control over that, and then just leave it. So what's your thoughts on that, and what's the most kind of common, I call it, blind spot that you see when doctors or healthcare professionals come to you?
Mm-hmm. Yeah, I would just say just a lack of diversification and really understanding that there are some major cycles that we really haven't experienced in quite some time. I don't know if you guys were investing, during the tech bubble in 2008, but really the market typically goes up for 15 to 20 years. When I'm saying the market, I'm talking about the stock market.
Right.
Typically it goes up for 10, 15 to 20 years. And then it tends to go sideways 10 to 15 years. And we've just been going up for really since, 2008, 2009. So it's been quite some time before someone's actually experienced like a sideways market or a pretty big bear market. And if you study something, I think I would love for everyone on this listening to this to just at least go Google these terms, which is the modern portfolio theory. And inside of the modern portfolio theory, there is, if you just type like MPT on Google, there's something called the efficient frontier, which just means that there is an efficient way to have the highest risk adjusted return for your investment portfolio. And the way that you do that is by getting assets that have different types of correlations. So that's why most people they'll put the 60-40 portfolio, 60% stocks, 40% bonds. The reason why they do that is because bonds tend to go up when stocks tend to go down. So they kind of even each other out, even though bonds generally return a lot lower of a percentage than
Mm-hmm.
the equity market does. So why wouldn't you just put all of your money in the equity market? The reason is because if it crashes and you're down 50%, you're probably going to get pretty emotional and sell and be like, no, I can't take anymore. And now you just realize the 50% loss. So it's all about trying to have more stability in your portfolio and letting your portfolio grow and compound over time. But the one thing that even people that are educated, that do have some stocks, do have some bonds, do have some real estate, gold, they're not highly educated on the alternative aspect of a portfolio. So there's a separate asset class that you would really call alternatives, which you could put like precious metals in there, like gold. But a lot of the times, what smart investors will do is they will put, like, let's say 5% of a portfolio into alternatives, like venture capital, private
Mhm.
equity, algorithmic trading would fit into that category as well. Things that can produce a much higher return, but they are higher risk. So that's why you are allocating a smaller portion of your portfolio there.
Mm-hmm.
But they can compound and grow at a much, much faster rate than the other assets in your portfolio. And having an allocation to a piece of a higher risk investment that could produce a higher return has been proven to be a good idea in portfolios. And that's what you'll understand by going and reading and educating yourself about the efficient frontier and how modern portfolio theory works. So I would say that's the big thing that especially medical professionals, they don't understand. I know it's probably above most people's heads. A lot of your terminology is above my head, so I can imagine that these things are above your head. Um, but it is important to understand because ultimately you guys are working for your wealth and you got to understand where your money is going and why, because if you can kind of map out a vision for yourself and make logical decisions, it could put you decades ahead of someone that doesn't. But that's where our product fits in. It fits into the alternatives category inside of an overall portfolio. So this isn't something where like you sell all your stocks and you put it into algorithmic trading. It's just a piece of your portfolio, if that makes sense.
Yeah, no, and that makes, like, as far as the BS free part, that to me right there is sort of the litmus test, right? Because I remember, like, my father was a physician as well, and we never had the conversation, which is you can write how to retire rich on the back of a business card, which is as long as you're plowing 10 or 15% of your income into an indexed fund against the S&P, you're going to be fine. If that's the only thing you did and you forget about it and you don't try to mess with it, you're going to be fine.
Yeah.
But of course he got sold like all these tax shelters and you got to buy a duplex, it's a tax shelter, and then he has a big management headache that he has to deal with. And I mean, he was such a nice guy, almost too nice in this regard. And so, like, I love this whole concept of algorithmic trading is a thing. It can be incredibly successful. It's not going to be 95% of your portfolio, but maybe 5 to 7% makes sense, especially with the volatility. Like, I would think you can correct me if I'm wrong. I would think that something like NERP with algorithmic trading would be really successful in the volatility that we're having. I mean, we're up 2% one day and we're down 2% the next day. This has just been wild.
Yeah, it has been crazy. Yeah, our core strategy is a momentum strategy that trades on gold. So you can imagine the amount of volatility we've had on gold this year. It's been one of the
Yes.
most volatile years ever. So yeah, it's done quite well this year. But you're exactly right. And there's some strategies that struggle during the volatility, like mean reverting strategies. Those tend to struggle because the markets trend too strong, and they're betting on price coming back to a mean. But on the trending like momentum strategies, those do really really well. So happy to talk more about that.
No, that sounds great.
Yes.
So it's not, just so that I make it clear to the people that are less financially literate. We're not going to Vegas and putting it all on red.
No, and the great thing is like the cool thing is you can have a predefined loss. So you come in, you open up an account, right? You put in whatever, 50 grand, 30 grand, 10 grand, whatever it may be. We've got people anywhere between 10,000 to $1 million. But you can set something in the portal that's called your equity monitor. So if you don't want to risk more than 10% of your account, let's say, you can just go type in 10 and now on the equity monitor, and now you're protecting the other 90% of your account. And if the account ever came down by 10%, it just closes all trades, turns off the software, and sends you an email, and then you can pick up and decide what you want to do from there. So yeah, there's definitely very strong risk controls that you can adjust. It's definitely not like putting all your money on black in Vegas.
Yeah, no, that's not good.
So we were just before, we went when we were driving here to the studio and talking about. I mean, your model, is it basically hedge fund? Would you call it that? It's like hedge fund operation.
Well, I would say we do our best to license institutional grade trading technology to the higher net worth retail investor. But I wouldn't call it a fund because we're definitely not pooling together people's money.
Gotcha. Okay. Because even Tim and I were talking about hedge funds versus other things we've been pitched, and my brain's pretty simple, and I like it in simple terms. And I was like, okay, well, let's talk about hedge funds and how they really work. So those are pooled, but it's betting against the market. It's kind of like your safe portfolio. Like I like to explain it, right? You've got the stock market investment, stocks and bonds, which has an average of 7 whatever percent return or more if it's successful. However, when people have their little separate investment portfolio, their hedge fund, that's hedging against when the market crashes so that they don't lose everything. Correct?
Well, they also want to. They
That's
also
how
want to
You
make
make
30%.
yes, you want to make money at the same time, but you want to make more money than stuffing it in a mattress, kind of, right?
No,
I
you're
mean,
right. I
yeah.
mean, that's how hedge funds were originally designed. But now hedge funds have kind of taken on a whole new animal, and a lot of them are actually really aggressive and they aim for really high returns. And some of them don't really hedge at all. You could be a long only fund, which means you're only betting on prices going up. So
Ah,
some hedge funds don't actually hedge the downside, but some of them do. You're exactly right. They will kind of follow a broader trend in the market up, and then at certain levels they will start to hedge 10, 20, 30, 50% of the portfolio so that you are protected on the downside.
right.
Yeah, because that's how they got their name, which was, you're a very high net worth individual. You put 10 million or 50 million into a hedge fund, and you may beat the market, you may not beat the market, but you're going to definitely beat the market on the downside. I mean, traditionally, if you research hedge funds versus the S&P, they've done much better at not losing money, but not necessarily outperformed the entire market over decades.
Yeah, yeah, exactly.
Okay,
But there are
so
some hedge like Jim Simons and the Medallion Fund. They were a hedge fund, but they were just taking a massive amount of really fast, high frequency trades on pretty much every asset that exists that's liquid on Earth. So they weren't just like buying an index and then hedging short on it when they thought it was a good idea. It was like a true just trading fund. All they did was trade in and out of different assets. So I wouldn't call it like really hedging. Maybe they hedged some of their positions that were in trades when there was heavy drawdown events like '08. But yeah, they're more kind of market neutral type performance because in trading your money sits in cash in an account, and then when an opportunity presents itself, you're putting capital into a trade and then exiting the trade, and that money comes back and sits in cash. So it's not like you're investing money and waiting for the prices to go up. It's just cash sitting in an account waiting for an opportunity, and then it enters and exits. So it just really depends what type of hedge fund, but you're exactly right. They were designed to protect more on the downside, but long term they generally underperformed because
Yes.
they didn't get as much on the upside.
So the fees. So as soon as I hear hedge fund, like the first thing that pops into my I was going to say pea-sized brain, but I have this like almost alien-sized head, so I can't really say that. Is the fees, right? The 220. They're taking 20% of the profit they make and so forth. So is NERP purely a subscription? Like I'm paying a subscription to use the technology in, say, my E-Trade account or something like that?
Yeah, exactly. You're paying a flat monthly subscription, and it's not based on performance. So like if it does if it has a really great month, you're paying the same amount as if it has an okay month or it has a down month.
So it's like buying your Apple, your Paramount Plus, and your
Yeah, yeah,
Spotify
that's right.
subscription. There you go.
Exactly. But it's probably less violent than Paramount Plus. I'm just assuming that that's the case.
So would I look at it, and here's me with my simple questions. Would I look at it as like, you have, if someone has a lot of their money in their 401k, would it be like having a separate little Roth where they could do their own little bit of trading to start off with, just to, or mess around with it, take a small portion of your investment portfolio and put it in there? Do you recommend to use it for all of it? How do you think that a financial advisor versus someone going into this fits into the big piece?
Yeah, I mean, we definitely have people using a Roth IRA with it because you want that tax shelter. But generally, I think it's better for more like speculative type of money. So if you had like an overall portfolio, maybe 70% of that's in your 401k and Roth IRAs, and then you've got some money that's outside of it. It's pretty normal for people to have money outside of their just their retirement accounts. So I think really partitioning off a piece of the money that's outside of the retirement account, because in my opinion, retirement is like, I want something that is very safe, long term. I understand how this thing has functioned for over 100 years, aka the total stock market, and just letting that grow over long periods of time, because that is truly your nest egg. That's the thing that you fall back on. So I would say outside of really the retirement vehicle is what I would do. I don't really use my retirement funds to do like higher speculative things, and I think generally that's the best thing to do.
Yeah, that's just common sense. That's great. I like
Perfect.
that.
So if someone has some specific interests within that, so I've gotten into uranium mining as one of my
Nice.
side interests. Yeah, and I like to mess
She's
around.
that's why she's glowing.
That's right. Yeah, glow, radioactive.
Yeah.
So can someone kind of pick and choose then what fields they're putting that money into, or is it really just follow kind of like a total algorithm and you put it in there, kind of like a vending machine type of thing, where it picks for you?
Yeah, so usually we have different types of algorithmic products that people can choose.
Uh huh.
Oftentimes people just look at the one that has the highest return and just pick that one, even though other products sometimes have other good features that are valuable. But our core strategy is actually what we were talking about a little bit earlier, which is a momentum strategy, and it only trades gold. So it'll trade on like gold futures on like U.S. brokers that have the futures market on gold, and then different types of gold contracts across different FX brokers as well. So there's hundreds of different brokers that you could use, but the strategy is a default strategy, and we've tested it for over 15 years. We've back tested it over 15 years, and we know that it has an edge based on all of our testing and then all of the live performance that is matching what we're seeing in the back testing. So what matters is that you have something that has positive expectancy, which means that the strategy makes money. On average, it's profitable on each trade that it's taking. Doesn't mean 100% of the trades are making money. Generally, it has like a 70% win rate. So about 30% of its trades it is losing. 70% of the time it's winning. But on each one of those, usually the winners are much bigger than the losers, which is what matters. But to answer your question directly, yeah, it is a core strategy that's built on one asset, and it trades that one asset very well. If you try to just grab the same strategy, you could technically try to go trade on the U.S. dollar or the stock market or other assets, which we have refitted the same type of strategy on those different assets. But it does need to operate differently. So we optimize that strategy across other assets. So you wouldn't want to take one algorithm and start running that on individual like different assets, because it wasn't optimized. It wasn't built for those different types of markets, if that makes sense.
How easy you've explained it's really easy for someone to get into this. I mean, you've given us some kind of thrown out some values from 10,000 to 250, I mean, whatever. Is it easy to get out of it if you say, I really need that cash for some other emergency? Is there is it like, no, you shouldn't be pulling it out now, or you're going to wreck the algorithm?
People love. Yeah, people love about, and that's why we that momentum strategy. It's the average hold time of a trade is 4 hours. Wow. And on average, it's taken 40 to 60 trades a month. So it's not an ultra high frequency. We've had some that have been taking 1,500 positions a month. That's always in trades. I would say the majority of the time, the account is not in trades. It's sitting there waiting for an opportunity. So It is very easy to withdraw. That's the great thing about the product. And when you get into alternatives, when in the alternative sphere and you're looking at private equity, venture capital, a lot of times you're locking your money up for 3, 5, 10 years at a time. Like you can't pull that money out because they're putting that into a property or to this business, or they're lending it over here. You can't get that back until they're done and they've executed their strategy. On this, you could deposit on a Wednesday and pull your money out on a Friday if you wanted to. So it's completely liquid. It's just a matter of sending money into a brokerage, and then you can just request to get an ACH or a wire back from that brokerage. So it's completely up to you if you want to turn it on, turn it off at any time, or deposit, withdraw at any time.
And then obviously it all falls into the same category, as in taxation, right? As general any income earned. It's obviously not a.
Yeah, that's an excellent question. How does that work? Because it's making it's making trades. You're technically realizing gains. So how does that work as far as a tax perspective?
Yeah, so there is some tax benefits with trading futures contracts. So it's section 1256. And sometimes it can be marked as long-term capital gains, which is taxed at a 20%. But for the most part, when you're trading in an account and you're holding the positions for less than 1 year, it's taxed on short-term capital gains, which is taxed at really your whatever your income bracket is. Mm-hmm. So if you're at the top income bracket, you might be getting taxed at like a 36% rate on whatever profit that you generate. But obviously, you're not getting taxed unless you're making profit. So it's not lose money and then get taxed on your losses. And there's different types of exemptions you can file for. You can elect to be taxed as a certain type of trader as well. There's like a trader exemption. But that's usually more advanced for people to have, tax advisors. But yeah, yes. You will be taxed typically on your short-term capital gains, just like your income would be.
Yeah, I have a sad story on that. I was trading some COVID penny stocks, and I made like 80 grand in a day, and then I sold and bought back. And then, of course, it cratered because I'm a moron and didn't just pull out my winnings and basically go to the casino. And so then I end up with I end up with this massive tax bill on money that doesn't exist.
Yeah, that's tough. I mean, didn't you just sell it back and realize a loss, and they kind of offset it?
I haven't sold it. We talked to our tax guy. I'm actually waiting because there's another investment we have that's going to hopefully come through in the next year or two, and that's when I'm going to sell it back and take that as a loss against the other win. So that's why.
Cool.
Yeah.
Okay, so I'm always the person that likes to I hate to name our children in this, but like one of our children, I like to sit back, watch someone else do a little bit in action, or hear real reports from friends, colleagues to see. Is there a way for someone to kind of watch this like on the computer and see what's happening to not a dummy fund, but someone else's, and trust it versus taking your word or ours from the show and before they hand over a chunk of money?
Yeah, I mean, we do our absolute best to educate people as much as we can about how the product works, because ultimately, if you don't have like conviction and belief in something, you're generally going to make bad decisions on whatever you're putting money into.
Right.
So yeah, we do our best to help people like understand how it functions even before. We also have a demo program, which is what we're actually putting you guys into, and anyone that's listening to this, you can get into the demo. And what that is a paper traded account. So it's $100,000 that is, fake money, but it's going to do almost exactly what, a live account would be doing. So you're going to run that algorithm in the demo account, and you can watch it function and see how it trades and see, how it reacts. And you can see that all in real live time as well. So when gold makes a big move, like it just went down, 3.5% today. It took 4 trades today, and I watched the thing manage all 4 of those trades in real time. So you can see that right on a chart. And then there's, our portal as well. You can just see, the balance and equity and performance and the daily, performance each day of the week. It's like a calendar. But yeah, to answer your question, if you're not the tech savvy one, you've got a younger person in your family. I have there's one of our clients lives on Star Island, and he's got I believe it's his kid or his cousin or someone that's kind of a younger, tech bro that understands all these things, which you don't have to be highly sophisticated, but for some reason he just likes to give it to him, and he's got a lot of money in there, but the younger kid is kind of the one that like manages, the account and watches
That's
it
funny.
and like updates it for him. So. Yeah, I've definitely heard of people doing that.
That's cool. So how if well, we will be doing this for sure, but
So
our
we're
listeners,
going to get our own. I call it. It's not Monopoly play set, but kind of like here's your money. Play around with it on the system and try it out to see how it works.
Yeah.
So how do we do that?
Exactly. Well, you're going to just get an email from us, and then we have a portal. So we have a licensing portal where all of our trading systems live, and you can, see the different trading algorithms and subscribe to them inside of the portal. So we're going to subscribe, your account to that strategy, which is called Midas, that trades gold. And all you need to do is create your logins from the email that we send you. And then inside of that portal, you'll see there's a bar on the left that says licenses. And then you will just toggle that green button, or it's a red button, and it'll toggle to green, which means that you're turning the algorithm on. So it is really that easy. Just you guys logging in and toggling that button to turn it to green, to turn the algorithm on, and then you can monitor it from there. And then anyone watching this call as well, you can do the exact same thing that they're about to do, that a lot of our prospects do before they buy, is they test the account through this demo structure. And I believe that link is right in the description of this recording, I believe.
And then, so just to confirm in my brain of how it's working, you watch that demo. Can you be really hands-on on it if you start to kind of get into it and want to make some adjustments yourself? Or can someone who's like, I don't want to do anything, I just want to let it set it and forget it and walk away? So is there room for people to do both?
Yeah, there is. Yep.
Okay.
We try to make it as simple as possible, where if someone was a really busy professional, they wouldn't be managing this thing and trying to spot all these,
Right.
patterns and things like that. Like they're not going to turn into a quant. But there are some things that you can adjust, like your equity monitor. Remember I mentioned that
Yeah,
earlier,
you
like
did.
how much money you want to protect in your account.
Yeah.
And then also the position size. So if you wanted to be more conservative using the trading algorithm, you could just turn down the position size. So instead of the algorithm taking a $100 trade, you could make it take a $50 trade,
Okay.
which is now really reducing the overall risk by 50%.
Right.
If you wanted to increase it and shoot for higher numbers, you could also increase the multiplier, and that would increase the overall risk of the account. So there are
Perfect.
some small things like that you can adjust.
I love it.
So this is going to be fun because I think we're having you back after we've messed with this for a
Yes.
month or two and see for ourselves exactly how it works, and that's going to be interesting. Like this is great. I have, since we've been doing the podcast for 5.5 years, and I've probably learned more. Not probably. We have absolutely 100% learned more just from talking to people like you and other podcasters about money and how to invest and whatnot than any training I ever got, either at home or in medical school. Like, it really is ridiculous because it's not that hard. Like, it's really not that difficult. I mean, we do stuff every day when we see patients that's far more complicated than figuring out how to, personal finance,
Oh yeah, I believe it. Yeah, you guys have very complex jobs.
But we've had training and the things that scare people are like money, health, and then I don't know, personal commitment probably. Anyway, so yeah, this will be fun to test this out in a model scenario. I love it. I just reminds me of when our kids did finance in high school, and they had the same kind of a program for the stock market, which was like a dummy system that they did and got to play the market, but followed it in real time. So this is great.
Yeah,
so
it should be good.
for people who want to check it out, I'll let you go ahead and tell everybody which website to go to, what the website and the information that they need, and we'll always obviously link it too.
Yeah, I believe it's just trade.nerp.com/doctors.
Okay.
So if you just go to that domain again, trade.nerp.com/doctors.
Perfect.
It should-
Yeah, and
you
we'll
should
put
be
that in
able
the
to-
show notes. That's right.
Yeah.
I think so. We have start.nerp.com doctors, but you
Okay.
will say trade.
Maybe it is start.
I think it's start. Yeah, start.
Yeah, okay.
Okay, we'll
Perfect.
put that in the show notes too. So I just want to reiterate to everybody that this is not financial advice. This was educational. I got a great education out of it, and if your ears perked up, you're interested, think about it. Maybe just don't act on this podcast without testing it out too. I think it would be great for other people to do it at the same time as us. Pull the numbers. If you're really concerned, check with your financial advisor and read the fine print. Ask all the questions. That's what we always say in medicine. Ask all the questions. Nothing's bad, nothing's rude, nothing's boring. Anything you'd like to say?
No, I think this has been great. I cannot wait to see how this works in real time in the demo, and then we'll see what happens after that, because the really attractive part is being able to use this advanced trading technology and still have access to that money.
Right.
Because that really opens up other funds that because it is, you're right, like we've done a little tiny bit of venture capital, and it's like that money's tied up till it either blows up and you make a bunch of money, or it goes away because it failed. I mean, that's it, and there's no set time limit to that.
No, and even was brought up in, we grew up in Canada, but it was always like GICs. You're tied into these bonds for 3 to 5 years, and you can't touch the things. And if something comes up and you want your money right then, what do you do? So I love it. Okay, well, everybody, remember, if this episode was useful, obviously we always say share it with a colleague, with a friend, and thanks for joining us. I'm May Hindmarsh. This is my husband, Dr. Tim Hindmarsh, and as always, keep it BS free.
It's no secret that medicine is a bit uptight. That's why Tim and I created BS Free MD, to mix things up a little and have fun in the process. Besides, we are having these exact same discussions all the time, so we thought we might as well invite everyone to the party. If you really like us, you can get plenty more, and maybe see one of Tim's cool tattoos on our Instagram or Facebook pages at BS Free MD. See you next time.
But we try to keep BS Free MD as raw and real as possible. We can't be held responsible for any medical decisions or discussions had as a result of what you've heard on the show. We know, bummer. But the truth is, we really do care about your questions. So feel free to reach out to us by email at doc@bsfreemd.com.